from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Ed Ludlow in New York, in for Emily Chang. This is Bloomberg Technology. Coming up in the next hour, tech continues to tumble. The Nasdaq 100 falls for a fifth day, its worst streak since February, as angst among global central banks and a strong dollar grows. Plus, Amazon goes after deal-hungry shoppers as retailers brace for a lackluster holiday season. The e-commerce giant will hold a second Prime Day sale this October in the fight back against inflation. And is it a bird? Is it a plane? No. It's your delivery falling from the sky. We talked to Zipline about the drone startup's new sound technology, the latest play to win over regulators. We'll get to that in a moment, but first, let's get a look at the markets. Tech continued its slide as part of a broad market sell-off spurred by sharp moves in the pound and a march higher in Treasury yields. And despite some mega caps closing in the green, investors remain subdued in the face of global monetary policy tightening. Joining me in New York, who else but Bloomberg's Katie Greifeld. Monday, volatility, madness. Where was the pain? It was an ugly day. Definitely a sell everything kind of market, but sort of the epicenter of all that pain was the bond market. Let's talk about the 10-year Treasury yield. Soared 24 basis points. It's dangerously close to a 4% handle. We haven't seen that since 2009. Of course, this is after UK gilts went crazy, after the pound hit another record low, but that bled right into the U.S. market and the U.S. bond market after the Bank of England didn't really do much to calm any sort of nerves. And of course, the ripple effect in, times of stress, correlations approach one. That's what happened today. Right. And it really took a whammy out of the stock market, too. I think what's really interesting, we talk a lot about the Nasdaq 100 because we're here in the US, so much of global mega cap tech is on the Nasdaq 100. But this has been a really global week, right? Mm-hmm. We've seen the impact of the pound. We've seen the impact of push higher, not just in treasuries, but in gilts as well. And global tech has fallen, but the Nasdaq 100 has kind of outperformed a little relative to the rest of tech stocks. It was a really interesting day, actually, because, of course, it did still close about 0.5% lower than Nasdaq 100, but you compare that to the S&P 500, which was down about 1%. It was an outperformance, and it was all thanks to that mega cap tech, like you mentioned. I mean, you had the likes of Amazon, Apple, Tesla managing to squeak out gains, and the sheer size of those companies, that's going to mask a lot of pain at the index level. Of course, those stocks have been falling for a while now, and that's been to the detriment of the index. But today, it was actually a little bit of a help. Maybe people are saying, okay, yields are higher, the discount rate is higher, but we're talking about Amazon here now. Does it really matter? We've done a poll, the MLive Pulse. I heard about it. And we ask a question, where does the Nasdaq 100 end the year? What's so astonishing is the strength of the response. You see it there on your screen. I think we're at around 11,000 level. The vast majority see us going lower to 10. A small section of professional retail investors see us going to 14,000. But it's really hard right now to call a bottom in tech stocks when those real yields continue to push higher. Absolutely. But to that point, if you're a bull, you probably love to see something like this. The fact that you do have such a strong consensus that this is a bad environment for tech. Just to go into the numbers a little bit, both professional and retail traders thought that the Nasdaq 100 will hit 10,000 before it hits 14,000. At 11,000, that's about a 10% fall. So definitely the crowd would tell you that there's more tech pain to come, to your point, as real yields march higher. But, we know that there's people going to try to catch that knife. I'm looking at Bitcoin. Yeah. We've been trading around 19,000 US dollars per token, and between 19,000 and 19,200, a kind of more narrow range than the volatility of recent sessions. What's the story with Bitcoin? Bitcoin, it's really making a run for it. Up about 1%, I think, today. It had been up as much as 2%. That doesn't sound like much, but on a day where you have the S&P 500 down 1%, you do see Bitcoin and crypto broadly bucking the trend a little bit here. Typically, those two assets trade hand in hand. But, I mean, at this point, there's been so much pain in the crypto space. Bitcoin, the largest coin out there, it's down over 50% year to date in this
current bout of market volatility, I think a lot of leverage has been flushed out of that market, and the marginal seller is already gone.
What is Katie Greifeld looking for this week?
You know, I am just trying to make it through weekend, but it's going to be really interesting to see what the bond market does here and the currency markets. To see a lot of the stress emanating from those two asset classes, you have to wonder how much pain there's left for stocks.
All right, that angst creeping into equities. Thank you to Bloomberg's Katie Greifeld. Now, Amazon's trying Prime Day again. The company is offering a 2-day early access sale on October 11th and 12th ahead of the holiday season. It's the first time it's done 2 Prime Day events in the same year. This as retailers across the world warn of a slowdown in holiday shopping. Here to discuss, Bloomberg's Spencer Soper. Spencer, what's the play here from Amazon?
Hey, why not? You know, try to slap Prime Day on it, try to get people excited, try to get a bunch of them to your site, sell as much stuff as you can. They've definitely got a lot of merchants dealing with an inventory glut, like a lot of other retailers. They want to move things quickly and they want to try to get people's money before somebody else does. So we've got this kind of race going on of Christmas creeping earlier and earlier into the season.
Was this a surprise that they would add a second Prime Day, or did we know that it was in the works?
Not really. There were some reports about it happening. I think it was the precise day was really the only news, and that they're kind of rebranding it as a Prime Early Access as opposed to calling it Prime Day 2, because Prime Day 2 just doesn't sound fresh enough or something.
You talked a little bit about inventories. You know, I think a lot of the sellers on Amazon had to do this juggling act, right, of supply chain crunch, getting things in for last holiday season. A lot of that didn't turn up until the middle of this year. So what's the risk here for the sellers on the Amazon platform?
Well, the risk is that they don't sell it, you know, so I think we're going to see prices drop a lot on consumer goods, you know, on non-discretionary on discretionary purchases.
Right.
So, you know, and then they're trying to align with consumer tastes. A lot of things people wanted the past couple of years during the pandemic, they just don't want anymore. So how do you entice somebody to buy that if they don't want it? You got to give them a great deal. So, you know, that's going to be the danger there. And a lot of these merchants anticipating taking haircuts and a lot of even retooling their product line to try to align better with what people are buying now.
What's the mood music been from Andy Jassy and Amazon about the state of the global consumer, about the economic pain that we're seeing around the world?
They haven't given a whole lot of guidance on it or said a whole lot. You know, they're still just trying to, promote their business, be the place to go for deals, be the place to go for your holiday shopping, preach convenience, and just try to stand out. You know, so basically, it's just going to be a dogfight for every consumer dollar, and they want to get everyone they can.
I remember the conversation you and I were having last year. I was in London at the time, but Black Friday, Cyber Monday. What does a second Prime Day event mean in terms of how consumers spend with those kind of other traditional holiday shopping periods?
Yeah, we don't know if they're kind of borrowing tomorrow's spending today. I think a lot of this is retailers just racing, realizing that people are probably going to be coming up against the edges of their spending limits come the holiday season. You know, it's like people are leaning on their credit cards to pay for things like food and fuel. You know, it's how they've been dealing with inflation. So come holiday season, they may not have a lot of room even on their credit cards, let alone money to spend. So I think they're just trying to lock those sales in while people still have money.
Hey, Spencer, what are we hearing from the retailers themselves that have their small businesses on the Amazon platform?
Just that they're not expecting the best holiday. You know, again, they recognize there's an inventory glut. They know that they're competing against a lot of other sellers, so they're going to have to pay for advertising to stand out. Then they're going to have good discounts to get buyers to compel buyers to buy. So they're not looking for a great holiday.
All right, Bloomberg's Spencer Soper, thank you very much. Coming up, Microsoft's valuation has dropped more than Apple's since the beginning of the year. Bloomberg Intelligence says this valuation trend could reverse, in part because the software maker is better positioned to survive a recession. We'll explore next. This is Bloomberg. Let's talk mega caps. Shares of Microsoft have dropped about 29% year to date, almost double the decline Apple has seen in its stock. But research from Bloomberg Intelligence finds if you get the microscope out, Microsoft is outperforming the iPhone maker on almost every single financial metric and might be better positioned to survive a recession. Joining us to discuss is the author of that research, Bloomberg Intelligence senior tech analyst Anurag Rana. Anurag, what is the thesis here?
So the thesis is very simple. When you look at the tech space, software's been killed quite a bit over the last 1 year, or I would say 9 months, because of rising rates, because it's one of the highest growth sectors. And, we think Microsoft has been, punished unjustly compared to the likes of Apple, who has performed better in this time frame. And our thesis is, if you look at the growth profile of Microsoft, it's better than Apple. If you look at the margin profile, it's better than Apple. And finally, and most importantly, it is a lot less dependent or exposed to China than Apple is.
I think we have a Bloomberg terminal chart that shows us the 12-month price to earnings multiples on both Apple and Microsoft. Microsoft come down a little below Apple in recent trading sessions. Are investors just sort of more focused on Microsoft's near term, what it's doing right now, rather than what it could do?
See, I think in both cases, Microsoft has not disappointed anybody in the last, I would say, quarter. And in fact, if we go into next quarter also, they haven't revised their guidance. Now, dollar is going to be an issue, so translation risk is there, and which we all know. But if you look at the constant currency growth, we see no reason why Microsoft cannot grow 12 to 15% in constant currency, at least for the next 2 quarters. And even if we hit a bad recession next year, we still argue that it can grow north of 10% in constant currency. It has a very diverse portfolio of software products, from cloud to Office to Windows, and a mixture of all of this should allow them to grow north of 10%.
So let's zero into that idea of being recession-proof, or at least better positioned to weather a recession. Microsoft and Apple do have different businesses. Why is Microsoft better positioned to weather a recession than Apple?
So we argue that enterprises are in a better position than consumers are. Now, in the case of Apple, Apple consumers in most cases are rich people, and they will continue to buy Apple, the iPhones. But if you look at a year-over-year growth comparison, Apple's consensus, if you just go by consensus for the next 3 years, it's high single digits. If you look at Microsoft, it's going to be in low double digits, at least for that time frame. So even without, diving deep into that, they can surprise on the upside because of cloud or because of any other reason. And this is not even accounting for the Activision acquisition going through. Microsoft is better positioned because of its enterprise presence.
There's one key market that we're all zeroed in on right now, and that's China. Where does China fit into this idea that Microsoft may be better positioned right now in some sense relative to Apple?
So if you look at Apple, Apple is very exposed to the greater China region. It generates over 20% of its revenue there. But more importantly, from its supply chain, bulk of the phones are assembled in that market. Any disruptions globally because of, COVID reasons or any geopolitical tensions, Apple will have a hard time to fulfill the demand for its products. While when you look at Microsoft, it does depend on China for its expansion of its cloud data centers. But other than that, it does not generate that much revenue away from China, or for that matter, is exposed to it either from a supply chain a lot less than what Apple is.
We broke some news the other day here on Bloomberg Technology about Microsoft's confidence that this Activision deal gets done, and the market really seemed to be paying attention. What was your read on that?
I think this is going to be a very interesting acquisition for everybody in the tech land, because I think the general consensus is that the regulators are going to be very tough on Microsoft, and which is partially the reason you see a massive price gap. But I think every couple of months we will see if there are no major I'd say hang-ups from the regulators, you would see that price gap closing. In fact, our antitrust analyst thinks that the deal is going to go through because of the nature of the deal rather than the size of Microsoft or the size of the deal.
Apple, fundamentals strong, near-term risk. Why did you write that?
Yeah, I mean, the reason we say that is because if you look at Apple for right now, 43% of their revenue comes from both Europe and China. And those are two geographies or two regions that are facing economic slowdown right now. In fact, Europe, we think, things are probably going to get worse in the near term before they get better. The second thing we want to point out is that the iPhone 14 is not a needle mover for Apple, just because the hardware design is still old, and in most cases, in the base model, even the processor is a bit old. And like the next year's model is going to be a big shift. When you look at the Apple's installed base of, let's say, 800 million iPhone, and with the refresh cycle of about 3.67 million phones, 3.6 years, you're going to sell about 220 million phones. We don't see that needle changes this year as much.
All right, Anurag Rana crunching the numbers at Bloomberg Intelligence. Thank you very much. Sticking with Apple, the company's begun manufacturing its new iPhone 14 in India much sooner than expected. Production is weeks ahead of schedule after Foxconn found the process surprisingly smooth. Apple is expanding manufacturing as tensions in China, where most iPhones are made, escalate with the US. At the same time, India has been key to make the country into a viable competitor to China in technology and production capabilities. And Apple's aggressive push into audio, specifically wireless headphones, has been one of the company's most successful bets. Bloomberg's Max Chafkin explains the controversial strategy around the AirPods.
Good morning.
For years, investors and fans of Apple have been waiting to see if the company's CEO, Tim Cook, can release a product to match the success of the iPhone. But Apple's next big thing might be in your pocket already. I'm talking about these little things, AirPods. Third-party estimates suggest Apple sold around 120 million pairs last year, taking in about $20 billion. And the reason for their success also gets to the heart of why Apple is so controversial. Partly it's a credit to the headphones themselves, but only partly. It's sort of easy to forget that when these were released, reviewers hated them. They didn't sound great, they got lost easily, they're not durable, they're environmentally questionable. But they had one thing going for them. They were easy to set up with the iPhone. This wasn't an accident. It was the culmination of Cook's strategy to transform the phone from a one-off product to an ecosystem of services like iCloud and accessories like the Apple Watch and AirPods. None of these extras really do much without the phone, and the phone doesn't work particularly well without them. Back in 2016, when Apple announced AirPods, the company also made everybody else's headphones worse by getting rid of the audio jack on the iPhone. To use normal headphones, you need an adapter. The company's VP of marketing said this was about one thing.
Courage.
Which, okay, sure, but it was also about Apple's awesome market power. That makes the company controversial. Spotify, Epic Games, Tile, and even Google all say it abuses its power. But antitrust litigation will take years, and until then, Apple can extract ever more money out of its 15 years young cash cow, the iPhone. Who needs the next big thing?
Thanks to Max Chafkin for that. Coming up, remote working during the pandemic has left many New York offices empty. How the trend is part of a larger property dilemma in major cities across the world. This is Bloomberg. The rise of remote work during the pandemic has put New York City at the center of a global property dilemma where multi-billion-dollar buildings sit vacant, leaving property owners in a bind. Bloomberg's Natalie Wong has the details. Now, as you know, I'm visiting from San Francisco. If I take a stroll down 3rd Avenue, there's far fewer workers going through revolving doors than there were, say, 4 years ago when I was last here. What's the story?
Right, and you see a lot of vacant storefronts as well. As you well know, a lot of workers are just not coming into the office, and companies are reducing their real estate footprint because of that. And those that are looking to expand are simply just not looking at an office building on 3rd Avenue.
You know, we're all still using tools like Zoom and Teams, Microsoft Teams. You know, there's multiple options. But what are the landlords going to do to fix this, to get workers and companies back into the buildings themselves?
A lot of landlords all across the city are adding amenities. They're putting in hundreds of millions of dollars into their office building to add stuff like outdoor spaces, new lobbies, new elevators to entice new tenants. And then hopefully those tenants will get their workers to come back in as well, as we're slowly starting to see happen across the city.
It's a long-standing problem. Same in San Francisco. There's just not enough apartments at an affordable price point.
Right.
But there's a lot of empty buildings, you just told me. How do we convert? And why is it so hard to convert those office buildings into residential?
That's a question that everyone's asking. You know, the reality is a lot of the Midtown office buildings are so big and rectangular, and there's just so much dark spaces within those buildings that it's hard to convert into livable residential areas. And on top of that, there's zoning restrictions with the city that doesn't allow for these types of renovations to be made. And there's no tax or financial incentives that are provided to landlords to embark on this super costly renovation.
That's the building owner's perspective.
Yes.
What do the tenants want? You know, what are they asking for?
Tenants want the best and the newest places. They want to be near Grand Central Terminal. They want to be near their peers, you know, private equity finance firms, mega big tech firms that are expanding on the far west side of Manhattan. And they have a lot of options to choose from. So if they're going to choose between, you know, a 3rd Avenue 1950s building that has sort of been renovated, but not really, or look at Hudson Yards where there's new skyscrapers and landlords are providing incentives to get you to move in, they're going to choose the newer ones.
Right. This is part of our Bloomberg Big Take, of course. What was the thing that surprised you most reporting this out?
I think the thing that surprised me the most was really just how much this impacts everyone, not just landlords, but tenants, and also the city. You know, the city has lost a lot of tax revenue due to the decline in the values of these office buildings, and it doesn't look like it's going to turn around anytime soon. All
right. Thank you to Bloomberg's Natalie Wong. Coming up, Andreessen Horowitz calls him the Silicon Valley CEO's CEO. I'll chat about venture capital and investing in a downturn with Race Capital's Alfred Shuang. Plus, later, crypto is considered one of the riskiest, if not the riskiest asset class these days, but the currencies are among the top performers this quarter. This is Bloomberg. This is Bloomberg Technology. I'm Ed Ludlow in New York. Let's get back to that market volatility. Major benchmarks like the Nasdaq 100 continue to fluctuate as economic uncertainty and monetary policy changes spur concern. And that includes a hit to all corners of the technology universe, making this a tough environment for everyone, from mega caps to Silicon Valley startups. Let's bring in Race Capital general partner Alfred Shuang. He's known as the Valley CEO's CEO. Alfred, what is your read on these markets right now?
Well, Ed, thank you for having me. Now, at Race Capital, we are seed and earliest investor in infrastructure companies like Databricks, Solana, and FTX. So when I saw Race Capital's founder, Sam Bankman-Fried, in New York last week, we talked about how the crypto market was in much worse shape in 2019 as is compared to today when he first started FTX. So the growth stage and the late stage venture market may have been dampened, obviously, by the recent market crash. But we are seeing early stage deals staying very strong, I think because of a few reasons. Number one, seed funding is not tied to revenue. Market slowdown has very little impact to early stage founders. So when we invest, we look for a founder market fit.
Right.
So, and most seed stage companies raise 18 to 24 months out runway, to find that fit itself. Number two, IPO is not the only route to exit anymore. I mean, we look at the recent Adobe Figma $20 billion mega deal. We can see the next 2 years is going to be very strong in making. So that's cyclical. And three, venture capital investors are sitting on $162 billion of cash for new investments. So these dry powders are driving energy to find the best founder and a lot of early stage deals.
So what you're seeing is not risk aversion like we see in the public markets, like we see in the later stages. Are you guys ready to spend? You're ready to deploy capital? Or are you sitting on the sidelines?
No, we are definitely not sitting on the sideline. We've been extremely active in investing. In fact, if you look at the cycle, post year 2000, post 2008, the very best breakout companies were invested soon after those crashes. Really good companies and strong founders, bubble up to the top, and then valuations are very rational. So you can make bets and be able to drive large ownership much easier. So this is definitely a good time.
You talked about valuations being rational. There's hundreds of startups out there, potentially more with unicorn status, right? billion-dollar valuations. What's the risk that we see those valuations come down, that there's a major repricing of startups of a certain size?
Well, this happens in every cycle. So the late stage deal obviously will be highly impacted by the equity market and where it's going, because that's where people thought the liquidity would be. But now we're also seeing, going back to the Figma deal at $20 billion in size,
right?
That's as good as any IPO could possibly drive for investors along the way. So I'm actually not concerned, because tech's always needed, and we're about to see one major revolution of going decentralization through Web3 of the type of application that will emerge in the next generation. So very good time indeed.
They call you the Silicon Valley CEO's CEO. You were an early investor in a lot of names we now know, right? FTX, Solana. You founded and took public BEA Systems, right? Give me the founder's perspective. How hard is it right now to be a fledgling startup or a founder with an idea to sit in front of an investor and come away with some cash in your pocket?
Well, without a doubt, raising money is not quite like last year. And founder has to be really on the game to be able to have a story about how they will be able to generate revenue. So thank goodness the word revenue and cash flow matters again. So which is a crucial thing of running real businesses. So, and the other thing is, run rate and costs and expenses. We're seeing a slew of layoffs, mostly not because those companies cannot afford those people, but they're rethinking how to get to profitability and cash flow positive. So those are things I think is good discipline that we should be seeing good CEO driving great companies that will last a long, long time.
There are some areas I know that you have a keen interest in, Web3 being one. We talk about that in such big abstract terms, what will big tech do when it comes to Web3? Will they do anything at all when it comes to Web3? Do you think investors are starting to lose a bit of patience there?
Well, Web3 is much more cyclical than the regular market. So if you look at the cycle of Web3, it's pacing at about 3 years, because we saw the last crash in about 2019. We saw a crash in 2022. So if we look at regular cycles, about 8 to 10 years. Web3 cycles about every 3 years. It's just showing the maturation of the technology is moving a lot faster than other cycles we have seen. Look at it. Like Amazon Web Services, AWS from Amazon, controls over 1/3 of Western world's internet infrastructure. Right? That really is unheard of. You have such, large, concentrated control of the internet itself, and then you have the other two players, following them combined. They control almost all of the Western internet infrastructure itself. So decentralization of the internet is greatly needed. We have been frustrated with centralized social media control. So the only way to solve it is some of that have to be by technology. So this has to happen.
Hey, Alfred, before I let you go, let me draw on your experience. You've been through the tech bubble. You've been through economic ups and downs. How does what we're seeing now in the global economy compare to what you've seen before?
Well, they were scary at times. So in the 2000 bubble, we're all super early stage companies that were listed publicly and getting trashed, when they don't make earnings. And the market, have no escape because it's all publicly done. So when the rug got pulled under, it was over. In 2008, it was a financial crisis. We weren't even sure if our banking system was sound and would continue to be a continuum. Now this is very different. I believe, obviously, we have major issue in the world. We have inflation. We have rapidly rising interest rate, which caused the market to be retreating to the level they are. And now a T-bill is generating 4%. We're in a whole different world. So I think from that perspective, investment has to change. But from a tech perspective, we're going to see insanely remarkable productive applications in the next few years out. It'll be better than anything we've ever experienced. There's going to be a great time ahead.
Race Capital General Partner Alfred Huang, thank you. Now, autonomous delivery drone startup Zipline has developed a new sound-based technology to help its aircraft better identify other airspace users. The company hopes the new tech will convince regulators to open up the skies for more drone-based deliveries. I took a trip to a Walmart in Northwest Arkansas where Zipline's trialing the tech and caught up with CEO Keller Ronaldo.
Is this about to become a more common sight? Zipline thinks so.
We're at the Up Summit, and the Up Summit is held in Bentonville, Arkansas. Let's talk about Zipline. What is Zipline?
Zipline is providing teleportation as a service to countries, to companies, and now directly to homes. We started with medical products. Today we deliver many different things to primary care facilities, hospitals, homes. Whatever people need quickly can be delivered via an autonomous aircraft. Zipline launched in Rwanda in 2016. Since then, the service has grown a lot. We actually initially launched just serving 21 hospitals. Today, we serve almost 3,000 hospitals across Rwanda, Ghana, Nigeria, Cote d'Ivoire, Kenya, and now the United States and Japan. I mean, we've delivered 1.5 million doses of COVID-19 vaccine, 5 million doses of traditional vaccine. We deliver 75% of the national blood supply of a couple countries at this point, fully autonomously, in a way that saves lives and saves countries money.
Talk to me how, in practice, that would actually work, loading the drone and going from there. Talk to me through the whole process.
Once the vehicle launches from the distribution center, it's flying completely autonomously, making all of its own decisions. It'll fly to the GPS coordinates, deliver the package, and we use a really simple, basically, parachute drop, which means that anybody can receive a delivery. You don't need any special infrastructure to receive a delivery. Then the vehicle comes home, lands, we can swap the battery, and have the plane back in the air 2 minutes later.
Zipline's latest gambit is taking on the US retail and e-commerce market.
Launching Zipline 963 in 3, 2, 1.
So when the Zipline drone shoots off the launcher, it's doing 0 to 60 miles an hour in 0.8 seconds. And the battery on the drone means that it could travel 200 nautical miles technically on paper, but they're limited to this 1.4 mile radius because the FAA have strict regulations on drones, right? This is what the whole story is about, using this technology in the real world. But this pilot in Pea Ridge, Northwest Arkansas, here at the Walmart store, if you live within that 1.4 mile radius, you can order your hamburger helper or your toothpaste or Q-tips or an orange, whatever you need, and they'll deliver it to your home.
To get regulators on board, Zipline's hoping a new sound-based technology will give other air users more confidence that skies full of drones are safe.
Explain to me the basics of the technology.
DAA stands for detect and avoid, and it's kind of a core problem for autonomy in United States airspace right now. When you have a really busy airspace, for autonomous vehicles, you must be able to guarantee a 2-mile all-clear hockey puck around the vehicles. There really is no good solution to that problem. We've tried using radar, we've tried using LiDAR, we've tried using cameras. Those systems are expensive, they're heavy, they're energy consumptive, and a lot of times they just plain don't work. Zipline is solving this problem using a microphone array. It's an extremely weird, practical approach to this problem, and one that we frankly thought was impossible 4 years ago as we started working on it. When you're flying through the air really fast, microphones are picking up a lot of ambient noise. You're also having to manage the noise of your own propellers, because the aircraft is making noise as it's flying, and you're listening for something that is somewhere within 2 miles of you. The amazing thing is that by using really intricate mechanical engineering design, different ways of designing this microphone array, and then combining that with like signal processing processing and neural nets that can listen to this sound that you're getting from the microphones, we can actually determine not only exactly where a vehicle is, but we can also determine the exact make and model of that aircraft. We think that this technology is going to have a big impact on autonomy in the airspace broadly, not just for Zipline.
Will this new tech take Zipline mainstream? Bloomberg NEF analysis suggests the use of drones would only be economical in highly specialized or niche situations like surveillance or mapping.
Is delivery in the retail context the biggest market opportunity for you?
There's a global transformation coming in logistics, and that is away from these big, heavy, slow gas combustion vehicles toward light, fast, electric, autonomous. It's really our mission. Our exclusive focus is just on approximating teleportation as a company.
Coming up, stocks, bonds, and commodities are all in the red since June, but cryptocurrencies are with the dollar as a top-performing asset this quarter. This is Bloomberg. As currencies around the world fluctuate, the sterling dropping to a record low against the dollar, there's widespread pessimism rocking markets. But cryptocurrencies during the quarter have performed, well, pretty well. What does this mean? Bloomberg's Sonali Basak, who else, is here to explain the relative performance. I see volatility everywhere. I see volatility in crypto. But if you dig a little deeper, there is some outperformance there.
It's really interesting to watch how the last couple of months have gone, because even though there are a lot of folks in the market that are worried that crypto will break again below that 17,500 mark, you still have the last quarter since the end of June, crypto doing pretty well overall. So if you look at a specific index that we look at, and this is an index of 100 digital currencies tracked by Bloomberg, you're looking at the MVIS Crypto Compared Digital Assets 100 index. It has added almost 7% since then. That is pretty close to its second performer there, that is the dollar, at about 8%. The S&P 500 and gold even has fallen in that time. So you're not looking at, of course, all of those classic risk havens performing all that well here. Now, there's some interesting questions here about whether that will continue on. Of course, crypto has fallen pretty meaningfully this year. I don't want to make 3 months a trend,
right,
but it certainly is something that has not fallen below that lower bound that we saw earlier this year, and in the last 3 months at least has been a pretty strong performance.
Yeah, not a trend necessarily, but we are looking for sort of the direction of travel. Sam Bankman-Fried, somebody that you know well, has been tweeting. I think we can bring it up here. Boy, with the world thinking differently about crypto price moves, they measured it versus world currency baskets instead of just the US dollar.
And I think that's a great point that he made, because of over the weekend when you saw these massive fluctuations in currencies across the world, you had the crypto crowd stand up and say, what does this mean for cryptocurrencies? And if you work in or live in a country where assets, digital assets, can be less volatile than your actual currency, you have people, for example, in Argentina that have flocked to digital assets in a very meaningful way, even El Salvador, even with that volatility. Then what does the digital asset mean? It means a lot more than if you're living in a much more stable nation.
There are still some dissenting voices, some of them louder than others. I'm thinking, of course, of Jamie Dimon, CEO of JP Morgan. What did he have to say recently about Bitcoin in particular?
Yes, of course, if you're looking in the traditional finance world, TradeFi, you are looking at Bitcoin as a decentralized Ponzi scheme, is what Jamie Dimon told regulators and lawmakers last week. However, let's think about what crypto has done and what it looks like. I wanted to point this out just as an exercise here, Ed. We had tips, inflation-protected bonds up. Why does that matter here? In the sake of crypto, crypto has long been, pitched as an inflation hedge. And I want to say, for the people who even say that that as an inflation hedge has fallen apart, so has tips, which are inflation-protected bonds, which was a hedge fund favorite this year. So you do see both traditional finance and DeFi hitting a little bit of, a roadblock here in the narrative in terms of what crypto means for many people.
Hey, very quick, we just had the merge. What's the next kind of calendar event that the crypto world looks to?
Yeah, well, it's funny that you mentioned the merge because Ethereum was a big part of that outperformance in that index in the last 3 months. But again, does that continue on, and to what extent does that filter into other assets? Do you see that same love in other proof of stake networks, things like Solana and the NFT world? As we know, there are a lot of interesting things happening when you look at the ape community, for example, and we've talked about it here, the Moonbirds as well. So again, the tangential assets to Ethereum we're looking at.
All right, Bloomberg Sonali Basak, thank you. Coming up, a delay in depositions. Both Elon Musk and Twitter CEO Parag Agrawal pushed their pre-trial depositions before the October 17 buyout trial. We'll bring you the latest next. This is Bloomberg. We're 3 weeks away from a court showdown between Elon Musk and Twitter. Starting October 17th, a Delaware Chancery judge will decide whether the world's richest person has legitimate grounds to walk away from a deal to buy the social media platform for $44 billion. Monday was supposed to be a key moment in the lead up to the trial, but it didn't pan out that way. Joining us to discuss, Bloomberg's Kurt Wagner. So Kurt, Elon and Parag were supposed to be deposed Monday. It didn't happen. What happened?
Yeah, both Elon and Parag essentially are trying to reschedule their depositions here. Elon was scheduled to be deposed in Delaware. Parag Agrawal, the CEO of Twitter, was going to do so here in San Francisco. And in both cases, it seems like, the timing isn't right. And we're told, or my understanding is that this is not super rare in a situation like this. But what makes it interesting, of course, Ed, is that we're 3 weeks away from this trial. The trial is 3 weeks from today, right? So there's only so many more days for them to push this thing before everyone has to sit down and share their side of the story.
I want to bring up this chart in my Bloomberg terminal, which I feel like I've looked at for years, but probably just months. And it shows the spread, right, of the current share price versus the $54.20 a share that Musk originally offered. And the idea is that, as the spread closes and the current share price gets closer to that offer price, the market's indicating that it thinks this deal will get done. Monday was weird. When we got the news that the depositions were delayed, the stock shot up and very quickly came back down again. There was speculation, it seems, in the market that we might be talking about settlement behind the scenes. It's not clear. What do you make of that?
Yeah, well, obviously, when two key players like this suddenly push their depositions, as you pointed out, you could see people jump to a conclusion here. Now, we have not heard anything about a settlement. And my guess would be that if there is a settlement, it'll come much closer to the trial because both sides want to figure out what information they can get from these depositions, right? I mean, they don't want to come to a settlement without covering every rock here. And so I think because there are so many people that they still have to talk to, it seems a little premature at this point. But as you point out, there are a lot of people who saw that news and probably thought, this is interesting. Why are these two people pushing their depositions? Maybe there's something happening behind the scenes.
Right. So the countdown's on. 3 weeks to go. What happens next?
Well, a lot more of this type of stuff, a lot more behind the scenes lawyer work, right? These teams for both Musk and Twitter are trying to position themselves, with the judge. There's going to be a hearing tomorrow to even find out, who can be deposed and who can't be. They're still fighting over stuff like that. So there's just a lot of jockeying for position at this point, right? And maybe there will be a settlement discussion at some point again as we get closer. But for now, I think both sides are just putting together their cases. They're kind of in that pre-trial preparation stage.
Hey, Kurt, you excited for our trip to Delaware?
I am ecstatic. We're going to have a great time. It's going to be a busy week, but it'll be fun.
All right, Bloomberg's Kurt Wagner. Thank you very much. I'll see you there. That does it for this edition of Bloomberg Technology Tuesday. We have ARK Invest Chief Futurist Brett Winton to share the latest on their investment strategy. Don't forget to check out our podcast. You can find it on the terminal as well as online on Apple, Spotify, and of course on iHeartRadio. This is Bloomberg.